How do you value this market today?
I think that just the way you said it is going to be a fool's journey to say, here's the stock market, and I'm going to time the movement into the market. I'm going to time the movement out of the market. Okay, you know what that means? You're going to outguess what the next variant move is and what the next other thing is. A lot of things depend on a lot of other things, and everything readjusts. What has to happen, I think, is investors, most importantly, have to realize two things. First, that cash is not a safe investment, is not a safe place, because it will be taxed by inflation. There will not be an interest rate will anywhere near compensate. And it seems good because it's not volatile, but you're paying a tax of a few percent a year on that. So A, stay out of that. And then B, know how to balance a portfolio, because the way portfolios work, it's almost like for some part, something happens, another thing happens. In other words, what you can see in the markets today is that, let's say when equities go down because growth expectations falter and there's a greater likelihood of easing, then you see the bond market go up. And when you see other markets, gold, you're seeing, and you could see those relationships. But wealth is not destroyed as much as it is transferred. And if you know how to balance those investments, we do it in what we call an all-weather portfolio. But if you know how to balance those investments, that's the most important thing. Be in a safe, well-balanced portfolio. You can reduce your risk without reducing your return, and you will not market time this. Because even if you were a great market timer, the things that are happening can change the world, so it changes what should be priced into the market. Let's go back to sort of basics. For every individual, for every company, for every government, over a period of time, you have to earn more than you spend, and you have a balance sheet. There's an income statement and a balance sheet. When one becomes a reserve currency, others want to save in that, and that gives one the exorbitant privilege of being able to borrow in that and to create debt and money, because that's the thing. And it also gives our sanctions come from the dollars being a reserve currency and so on. However, through history, it has always happened that currencies are devalued or destroyed. And in that cycle, when it becomes unattractive to own bonds or debt instruments in that currency, there's a supply-demand problem, because a bond is a promise to receive currency. So what you are is, when you own a bond, you're long a lot of currency because that's what they promise to give you, and they have the printing press. And then there are shifts that happen. Who is accounting for world trade? Right now, China counts a larger share of world trade than the United States, for example. So what we are doing is we are in a fiat monetary system in which we are running very large deficits that we are monetizing, and that those deficits produce bonds that have to be sold. When I look at the supply and demand for those bonds, I know who the buyers are. You know, there are a limited number of really big buyers. And so I look at their portfolios and so on, calculate what that is. There's not going to be enough demand for those bonds, and there's going to be a need for more monetization of that debt. And so the answer is, yes, we're producing a change in the storehold of wealth. And you've seen it in the markets, because just think of it in a mechanistic sense. When there was that stimulation and the buying, what the Federal Reserve did in terms of buying that assets, there was not only the decline in real interest rates. We had, about 150 basis points decline in real rates and nominal rates down there. So the discount rate was lower. You also had a lot of liquidity which came in, and the world now has an enormous amount of liquidity bidding for financial assets. And so if you increase the supply of bonds and you increase the amount of money, bonds are going to be worth less relative to other things, and you're seeing a shift in the storehold of wealth. And like the 1933 period, when Roosevelt did the same moves in 1933, you then saw assets rise because they're alternative storeholds of wealth. That's what we saw in terms of the liquidity move that we've happened in market, also included in gold and so on. And so that's how it looks to me in terms of the comparison. We're in a new era. We are pressing the limits of that. That money, at the end of the day, whoever's accepting that reserve currency's got to believe in it.
Hey, Ray, one of the things you do write about is China. Some would argue that you have a generous or more sympathetic view to China than perhaps some of the most hawks, if you will, about China. But you think that there's sort of an inevitability to the transfer of wealth of sorts.
Well, okay, two things. China, transfer of wealth. I just know China very well. I've been going there since 1984. I know leaders and I know how they're thinking and I know the moves that they're making in a detailed way. And I'm just trying to share what that perspective is, because I think a lot of people make stereotypical moves. And I think you have to really understand, because it has been a remarkably successful place. Since I started going there in 1984, per capita has increased by 26 times and so on. So to not understand it or to approach it with a great bias in terms of the element of, let's say, a transfer of wealth, or let's call it common prosperity. Yes, there's a world, in this world right now, there's a move to common prosperity. I would say what are called progressives here are much more left than what we would call progressives or whatever the Chinese policies are doing. But yes, worldwide, there has to be common prosperity, or let's call it broad prosperity. And the question is whether that's going to come about by productivity or not. It doesn't mean that you're going to have like a communism that's going to take all of that. There's going to be a lot of productivity in China. And so again, diversifying the portfolio. And also, let's just think about capital flows. China is becoming an effective place to invest money. Something like 40%, over 40% of the IPOs are going to be Chinese stocks on Chinese market. Capital flows work that way. And history has shown us that when there's an empire, an emerging empire, they build the financial markets, they build the financial system. So Amsterdam was the world's financial center during the empire when there was the Dutch guilder. London was the financial center in the British Empire. US, we had New York. And so we're seeing that merge. All of that changes the supply and the demand that is threatening to the reserve currency status. Just imagine it's the state of Connecticut, the state of Illinois, and so on. And you can't print the money. That means you either have to raise taxes or cut spending. And history has shown in these empires that that causes great conflicts, because raising taxes and or cutting spending has been all through these empires. And I've studied, I don't know how many over a long period of time, the number one reason that you have civil wars. So yes, it's easy to say we have to earn more than we spend and so on. But in this environment, in this highly fragmented environment, how are we going to get there? What I decided to do, I was doing the research for myself in Bridgewater, because what I learned through my life is that all the surprises, the big surprises and mistakes I made whenever they occurred were things that didn't happen in my lifetime before, but happened before my lifetime. Like in 1971, I was clerking on the floor of the New York Stock Exchange. August 15th, I remember it very well. Nixon announces that money as we know it is not any longer going to exist, and people wouldn't accept dollars in Europe. And I went on the floor of the New York Stock Exchange, where I'm clerking, the next day, and I thought there was a crisis, and I thought the stock market was going to go down a lot, and the stock market went up a lot. And then I said, okay, well, why? And I studied history, and I studied devaluations, and I studied that the exact same thing happened March 5th, 1933, with Roosevelt's move. And I understood when you devalue, you reflate, and it has this positive effect on that. So what's happened recently is that I've observed three big things that are going on that haven't happened in our lifetimes, and that they're big, big, big things. And so those three big things led me to want to study them in history. And they are what's going on with money and credit as you get zero interest rate, and everybody needs a lot more spending power. The production of a lot of debt that is monetized and directed by the central government to the places they want it to go, because the capital markets won't get them there in that way. That phenomenon came loud and clear through COVID, but it existed before. And so that leads me to the supply and demand of money and credit. And I realize who gets it and who doesn't get it drives not only the markets, it drives our lives. So that's one. The second factor is the emergence of populism and the wealth gap. So when Trump got elected, and there's a lot of populism around the world, that didn't used to happen in developed countries in the same way. And I decided to study the distribution, the deciles. So I took the bottom 60% of the population and I looked at those conditions and so on. And I realized that the wealth gap today is the largest since it was in the 30s. The monetary policy I'm talking about, last time that happened, zero interest rates, a lot of monetization, 1930 to 45 period. The wealth gap and the conflicts that we're dealing, last time that happened, 1930 to 45 period. So that factor, we're at each other's throats. We have conflicts primarily over money and wealth, and that defines tax policy. So when we look into the new administration, whatever that may be, we're going to think about those policies. I needed to put that in perspective. And then the third is the rise of a great power to challenging an existing great power. The world order that we're in began in 1945. The United States won the war. Basically, it accounted for 50% of the world's economy, had 80% of the gold. Gold was money. And so we built a dollar-based and US-based order. And now we're in a position where the Soviet Union was never economically comparable rival. They had nuclear power, but not the same. And so we're now seeing every day that rivalry. And so by being able to see that, we perceive changes pertaining to that. So those are the three factors of our lifetime, which then said, I need to go back and find out what determines a reserve currency and not. Back 500 years, because I needed the cycles. It used to be the Dutch Empire, the British Empire, and the American Empire. And that's what I did. So the reason I wanted to share it was I'm now at a stage of my life, 71, and my notion at this moment, and I'll do this for maybe a year or two more, is to pass along the things that I found valuable to other people for them to take or leave as they like.